Welcome to Imperfect Company, podcast where we can get the best founders in Australia, the most interesting founders, to come and talk to us about their journey and, most importantly, tell us the real story of how they built their companies and the mistakes they made, the lessons they learned. And that's why we've called it Imperfect Company.
Yep.
I'm far from perfect. You're more perfect than I am, but we're
Thank you for saying that.
We want to tell the real stories of what it's like to build a startup out of Australia. So between us, Sam, we've built 2 companies.
Yeah.
And we're building 2 more.
Yeah, we are. Cloud Guru for me and Aconex for you. And we've both built a company and sold a company. And now we're both crazy enough to go and build another one each and start a fund as well.
Yes, and we can talk about glitch through the episode.
Yeah.
The one thing when you built your company, of course, though, you did it far faster than Aconex, and we'll come to that. 6 years, I think it was.
Yeah, six and a half, something like that.
From a garage to or a bedroom.
600 staff, big exit. It was a very wild ride. Yeah. I learned a lot through that speed, but also had to learn it very quickly. So in some senses, it would have been nicer to have longer, even though that seems counterintuitive. But yeah, it was a crazy journey.
Cool. We'll dive into that.
It wasn't AI speed though.
Wasn't AI speed, and we'll come to that. And one of the things, of course, we wanted to do on this first episode was we're going to be talking to other founders, but to tell our own stories a little bit around what we did first time round and then what we're doing now with Cutable and Firmable. Great. Well, Sam, let's jump into your story. So for those of you who don't know Sam, and most of you should know Sam, but if you don't, Sam founded a Cloud Guru 6 years ago, well, not 6 years ago, back in 2015, 6-year journey, founded with your brother, Ryan.
Yeah.
We'll talk about that.
Yep.
Having a brother, I mean, Rob was a co-founder, but never quite a brother, although we were in boarding school together.
You needle each other like brothers do.
Which kind of like, he's kind of like a brother in the worst possible way, perhaps. And then you, so from a bedroom, you then built the company up, sold to Pluralsight for $2 billion in 2021. And I think when Aconex exited, we were the largest at that point, and you very promptly beat us on not that it's about the dollars and not about the numbers, but a $2 billion exit was huge. And of course, for those of you who don't know, Sam is also the co-founder of Cutable, and we'll talk a little bit about what it's like to go and build an AI native company and what that all means today. And in a fast moving, tech disruptive environment.
Awesome. Cool.
So let's jump in. So tell us, you started in a bedroom. How'd you get going? What was the reason for a Cloud Guru?
Actually started with my brother was he was in kind of infrastructure as a service. So think of like solution architect putting hardware systems together. Like in the old world, we used to work for Rackspace and, when everything was about data centers. And he saw cloud computing coming and was really worried about that taking his job. Like, hey, if people are just going to be able to rent servers on the internet, then we won't need to set up data centers anymore. So we thought, hey, why don't I try to get a job with Amazon? Like if you can't beat them, join them. And he went through this interview process to get a job there. Took 3 months, multiple rounds. And in the last round, they turned him down. And he was pretty despondent. But what he'd learned during that interview process, he had to learn everything about cloud computing, and he'd found it really hard to learn.
Yeah.
He had to go like take a week off work, spend $5,000-$10,000 for in-classroom training. And so he thought, oh, well, maybe I should just record literally with his little laptop. He went and bought he lived in London, 30-pound webcam from PC World.
Made the first video.
Just made a video of himself teaching AWS, teaching cloud. And he put it on udemy.com. And it just kind of went wild. People started buying it for it was like $10 course. And within a month or so, he had a few thousand students.
So then he brought you in? So you weren't...
Yeah. And so he was kind of just selling this course on Udemy for like extra money for a few months, but it started ramping up and we were looking at it. And I remember I had this phone call with him. I still remember like standing in the front room of my house in Melbourne, talking to him in London and just saying, there's something in this because there's a whole need to get the industry into cloud. But there's no good way to learn it easily. And like, you don't want to learn on something like udemy.com because it's, there's like, they teach everything. There's no community. So why don't we build an online school where engineers can come together and help each other? And yeah, that's how I got involved. And so I'm a programmer by background, and so I spent every night and weekend for the next few months building our school. So my brother would make the content.
Yeah.
He would record it on his webcam, and then I would put it up on build the school online and put it online and sell it that way.
So you basically built the tech. He did the videos.
Yeah, that's right. He did the content. I did the tech. It was probably for the first, I'd say 9 months. That's kind of how we went. The two of us just dividing and conquering.
And how did you get your first customer? I presume somebody found you online and started paying.
So we were actually it's funny, you look back, we were quite strategic about this. It did not feel strategic.
So it was a PLG motion?
Yeah. No, it was like, hey, people are buying this from Udemy. We don't want them to buy it from Udemy. We want them to buy it from us because we give Udemy half the money. And it's $10. So you can't control the price. So can we get those Udemy students to come and buy from us directly? So the first thing I did was build an app to do practice exams.
Yeah.
And so we would put it in the Udemy course. Hey, if you want to practice for your exam while you're doing this course, you want to learn on the bus or on the train, just go and download our app. And the app we charge $30 for, even though the course was $10. And we're like, well, let's see if anyone will pay $30 and buy from us directly. And then that started doing really well. We realized, okay. And over a year or two, we built this whole way to funnel our students from Udemy to our website and buy the content directly from us. And then, of course, from there, we didn't need Udemy anymore. But that's how you got going. Locked it. Yeah.
And first capital raised? Or first employees, maybe, because you would have brought on some people before raising capital.
So we built
largely bootstrapped.
We built bootstrapped to about $3.5 million USD in ARR.
Yeah, wow.
And we did that in the first 2 years, year and a half, 2 years, which at the time I didn't realize that was good. Because I wasn't I wasn't investing in businesses. I wasn't part of other startups. So we basically built $1 million cash in the bank. We're like, that was our goal. Let's just get $1 million US in the bank.
Yeah.
So we have some buffer if all of this blows up, was basically, that was what we were going for. So we built that out. And then in 2017, we started getting approached by VCs and had no idea what we were doing.
So they were approaching you. You hadn't gone out to them?
No, that's right.
Australian, US VCs?
US and Europe.
Right.
Yeah, I didn't know any Australian VCs until we raised, basically, and then I got to know the Australian VCs because we were no one knew us here. Because
you were selling internationally.
We were selling internationally. Yeah. Australia was never more than 5% of our revenue. And so we weren't really well known here for the first couple of years until we did that US raise.
Right.
Yeah.
So US raise at 3.5 mil run rate at that point.
Yeah. I think we raised 2 or 3 million. Yeah. Now Series A. Series A's looked a lot different back then.
Yes.
Much lower valuations and much lower check sizes. Probably more like what you'd call a seed today.
Yeah. And so then you continue to build the business out of Australia? Ryan's in UK still? Or?
After Series A, we brought on a COO, which our plan was to expand into the US. I didn't live in the US. I didn't want to move there. My brother, the same. And so we brought on a COO who headed up the US operation for us, which I think was really critical. You just need someone on the ground day to day.
Yeah.
And he was kind of like a third co-founder in how impactful he was to the business.
Yeah.
Our VCs helped us find him. And so he was in Austin, Texas. And so we started building our US headquarters from there.
Around.
Yeah. And by the end, Austin was probably 400 people. So 2/3 of our staff, and US was probably 80% of our revenue.
Yeah. So you're 2 years in, 6-year journey.
Yeah.
So you raised then.
Yep.
Another raise, was there?
Yeah.
Before the Pluralsight deal?
We did a B round about a year later, year and a half later. We did a B raise. At the same time, we had a company trying to buy us. So we were kind of working out which way to go. Do we get acquired or do we do the B round? And they ended up offering similar valuations. So we thought, let's just do the B and keep going. Yeah. Where there's not any upside and we really wanted to keep building. So did the B round. I think we raised 25 or 30 million.
It's a B round then.
To remember. Yeah, it was something. It's amazing how much of the details you forget. Well, I do anyway. So We did that in 2018. And then not long after that, we had the opportunity to buy our biggest competitor, which was probably the single most impactful decision we ever made. Because, acquisitions can go one of two ways. Yeah. They either work or they fail hard.
Yeah.
And that was a crazy one because they were actually bigger than us at the time. So they had a higher revenue. They were an older company, but they were growing like this and we were growing like that.
Your VC, did you have to raise capital to do that? Or
yeah, and that's a crazy story. I had to raise $250 million US in 3 weeks.
Wow.
To get the deal done and managed to do it. So I was just flying all over America and trying to get
massive deal.
Trying to get the founder over the line as well because he didn't want to sell it to us because we were his biggest competitor. So there was a lot of a lot of tension there. So we ended up bringing Bain Capital, Summit, who did our B, went in, and our A backers as well. We did like an SPV.
Your VC, so Summit was your B round. Did they help in that process, or was it largely you driving it?
No, they help. They definitely help with capital.
Yeah.
I would say leading the deal was me and the head of the fund from our A round, Elephant.
All right.
And then Bain came in to help do due diligence. It was
So this was year 5, is it? So year 5 are we at now?
This was like year 3 or 4. What was crazy about that though is that there was a lot of competitiveness between the companies, because we were like the young guns kind of coming in, and so the founder didn't like that. But also that founder had offered to buy our company when we were 9 months old, and we had met. That's the only time we'd met the founder. We'd met him in LA, and he offered us a bunch of money to just walk away.
Yeah,
which was like the hardest thing. Because we were less than a year into this business. And when someone offers you a bunch of money for a year's work, and you're like, oh, I don't know if I'm ever going to get this again. It was the kind of money I'd never even dreamed of. But we'd said no to it, thankfully. So then it was funny, 3 years later, we ended up buying his company. So it was just this incredibly competitive dynamic. But it worked so well. It was great for him. It was great for us. And within 18 months of that acquisition, we tripled the value of the combined companies because we were now the strategic company you had to buy if you wanted to own the cloud computing market, which was the thesis of the acquisition, but it actually worked. So often you have a thesis and it doesn't work.
Yeah.
It worked really well.
And clearly AWS was around what you were doing. Did you partner with them at various points? How did you work with the various cloud providers in the market?
Yeah, it was a really weird dynamic with AWS because we were powering their business so much because the number one barrier to adopting and spending more with Amazon was, did people know how to use it? So we were training people to use their system, which meant they'd spend more. So but what ended up happening was they also had their own training offering, which was competitive. So they couldn't recommend it because they made their own training, but the challenge was our training was better, so the market was adopting ours, but they had their own incentives to build their own training. And so what ended up happening is we noticed early on that AWS employees were using our platform to learn AWS. They were all signing up, just B2C, putting their own credit cards in with their Amazon.com email address. So we noticed we had a few thousand Amazon employees on our platform. So we made this call to say, hey, instead of taking money from these guys, why don't we make it free for everyone at Amazon? And so if you sign up with an Amazon.com email address, you get Cloud Guru for free forever. And so we did an email blast out to those 2,000 or 3,000 Amazon employees and said, congratulations, Cloud Guru is now free for you forever. You forward this email on to anyone at Amazon.
Oh, wow.
And it just spread like wildfire. And in the end, we trained.
So they would then recommend it to their customers from that point on.
Yeah. And so what happens is if the people inside Amazon learn Amazon from Cloud Guru, then when the customer says, well, look, how are we going to learn this? They say, well, the best way to learn it is Cloud Guru. That's how we learned it. Yeah. Rather than recommending their own training.
But presumably AWS, whoever was running training for AWS didn't like that.
It was very competitive. So there was all this politics where they couldn't officially recommend us, but they'd go on the side, hey, go use Cloud Guru. And in the end, we trained 2/3 of AWS's workforce how to use AWS. So we trained 50,000 Amazon employees. And so that decision to offer it free
Yeah,
probably the most impactful thing because we ended up over the years, we got this kind of unofficial partnership going with their sales team. So their sales teams would actually start to recommend us alongside their own training. But it was this really like, I think it probably led to 20 or 30% of our revenue came from Amazon recommendations. So yeah, very impactful decision early on. Yeah.
Great. So then, and we'll come to what you're doing now later, but it's a Pluralsight then. So you end up, how did that all happen, and what were without getting into all the details, but what was the sort of main, did they approach you?
Well, like I'm sure you know what it's like. When you run a business that's growing well, you get people reaching out all the time to talk about, let's talk about strategic partnerships. And it's all kind of code for potential M&A. And so there's always people sniffing around, but they never becomes that serious. Or it feels like they're always just kind of wanting to be around the hoop. Then in 2021, end of 2020, start of 2021, we had 3 buyers all kind of start sniffing around quite seriously at the same time.
Yeah.
And one was pushing quite hard. It was a public company. They'd raised money to make acquisitions. This was in the zero interest rate COVID era. So like everyone was trying to find places to put money.
Yeah.
So we ended up saying, you know what, I think it's time to run around because we had 3 parties all talking at pretty serious valuations. So we thought, let's not run around, like let's run a process.
Yeah.
So we got the bankers in and started, kind of managing it properly. And it was kind of the dream scenario, to be honest, because normally with acquisitions, there's 1 buyer, not 3. And, everyone wants the competitive bid, but it just doesn't happen that often.
Yeah.
Right? So you're normally having to hedge against, well, we're going to IPO,
run a dual track.
Whereas this was easier because it's like, no, there's 2 other buyers. Right? So that went over a few months. And Pluralsight, so Vista Equity ended up buying us. They bought Pluralsight at the same time. So they had bought Pluralsight, which was a public company, and they were taking it private.
Yeah, and then putting the 2 together.
And they put us under Pluralsight.
So actually Vista did the deal, not Pluralsight.
Vista did the deal. It was actually, the 2 companies were merged they actually lined up the timing. So the acquisition of Cloud Guru and the finalization of the year-long go private happened on the same day. Yeah. And so I think the day the employees at Pluralsight found out about it was the same day they were finally private. They got told, hey, by the way, we've also bought this company, and now we need to adjust. Yeah, so it was a pretty wild time. Yeah.
Well, great timing for you.
Great.
I think, it seems like you timed the market perfectly.
Yeah, we had that discussion at the start of 2021. Do we want to sell? Do we not? And the discussion we had is like multiples are really high. Like they're historically high. We knew they wouldn't stay there.
Yeah.
So it was like, we said, well, we could run this company for another 5 years, grow it, and get the same valuation. Right? That's quite possible. And I felt like from my own perspective, I had achieved what I wanted to achieve, which was to build a great product company I was really proud of. And I felt like I'd achieved that. So it felt like the right time. Yeah. And thankfully, if you saw what happened to EdTech a year or 2 after that, it was very, it was fortuitous timing because EdTech took a beating after
not the only
COVID.
Part of tech that's taken a beating of late.
Yeah.
Some areas are great. But SaaSpocalypse, whatever you want to call it. Great.
But we made a lot of I would say looking back, it looks all very strategic and made a lot of good calls. It was like some of it was strategic. Some of it was just trying a lot of things and working out what worked. And some of it was just really good luck and good timing. Yeah. Bit of a mix of everything. Yeah.
And post-exit, how'd you feel?
Great. Yeah. I mean,
post-exit. So you left? How long did you stay around for?
I stayed around for about just under a year.
Yeah.
And kind of handed it over. But I wasn't the right person to work under a CEO inside a bigger company. I'm the wrong leader for that. So I helped hand that over. But took a little bit of time off with the family for about a year. I've got 5 kids, so I've got a lot of family to juggle.
Yeah.
And then just couldn't stop myself getting back into building because that's what I love doing. Found it. How old am I? 40, 41? 42. And I just didn't want to sit around. Like a lot
of time still to go.
Yeah. And with AI coming, like we won't get into it now, but that was the most exciting thing to me.
Yeah.
The AI wave is everything I got into tech for. Like this is finally happening.
Yeah.
Right?
Cool. We'll come to AI in a minute.
Yeah.
Awesome.
So tell me about Aconex.
Different era, of course. This is back. I mean, our first customers didn't even have internet connections. They would go to construction sites but right back it was.
So when was that?
I was in 2000. So I was at McKinsey, McKinsey & Company. Rob Philpott, the other co-founder of Aconex, was at Multiplex, and it was .com boom, so it was first wave internet. And I'd done a couple of years at McKinsey advising McKinsey's clients, some of their clients, on what the internet meant for their business, and largely because not that I was a coder, but I'd done a little bit at uni, but had done engineering and at least knew what the internet was.
Yeah.
Probably not a lot of people did back then, or at least hadn't used in a business context. So went from company to company helping them.
So you were strategic. So you actually went and gave strategic advice.
And then probably the reason I started Aconex partly was we give this advice and you're thinking these guys don't quite get it or they won't do it. I won't mention the companies, but some large Australian companies just did not take the advice we gave them, and their trajectory would have been very different had they taken it.
Were you always around construction?
No. That was everything. It wouldn't no construction. So it was just, it was media companies, fast moving consumer goods companies, just all sorts of different companies. But sort of ended up pretty much in some banking advice too. So again, working with one of the large banks on what the internet does to their business. Do they need to build? Should they be building an internet bank? And sort of first wave internet. And of course, today you'd look back and go, well, why wouldn't you build an internet bank? But there was still.
Yeah, well, it was WAP probably back then, right? I remember that, like, before you even had edge internet, there was like, do you remember like all that?
Oh, and then they were worried about, there's so many things that you look back and go, well, it's sort of obvious. But so anyway, wanted to build something. We thought there was the internet's come, we've got this incredible new tool, a new way of delivering product to people, new way of managing information, that I've got to do something in that. So Rob was at Multiplex, so over games of squash and beers at the pub, I'd say, surely we can do something with the internet in construction. Day in day, you're working there day in, day out. What are you doing day to day that you could do better? And one of the things Rob said very early on is I get all these drawings. I get a big stick of drawings, so stick being a roll of drawings, and I have to manage that out to all the various subcontractors. And it's like, surely the internet could do that better than just managing it by hard copy. Unless you go into an office and it'd be these massive
physically printed.
These are like A1 prints. They'd have the plan racks. They'd send out bundles of documents. That's what Rob was doing, and also managing a spreadsheet of what he'd sent out to whom. So we thought there was an opportunity to do something there. We also thought something changed. We thought would be a place where you might buy and sell construction products, so like an exchange. That didn't work, but the piece of the product that everybody, as we started speaking to customers, wanted to use was this document management system. So we basically digitized or helped digitize the move from hard copy distribution of documents on a construction site to digital, and keeping a track of all of those versions. So the hard thing in construction is you don't just have one drawing of a floor, say, or a plan of a floor. You might have 20 versions of that over the course of the project. So a lot of heavy lifting in terms of information management. So built that out, but it was hard yard. Selling to construction companies was almost impossible. You'd go in and you had to tell them what the internet was, explain to them why the product would help them and why they would therefore need the internet. And then somehow get them to use it. And the thing we had working against us, the nice about Aconex is we had network effect, but the network effect works against you early on. So we had to get the builder, the owner, the client, and also usually the lead consultant, the architect or the engineer to agree to use it.
And the problem is you need all of those people to be forward-thinking enough to want to do it online. Right? And if one of them is like...
If one of them said no, if the client said no, you had no chance. If the client said yes, then you had to get the builder, and then the builder... If they couldn't get at least one or two of the lead designers, so the engineer or the architect to agree to use it, you were dead. So, so it was complicated sale, or we had to sell to multiple parties. And typically our customer was either the builder, the contractor, or the client, but the owner. But then, you still had to get others to use it. And then we had the subcontractors. So then And they would tend to do what they were told, but it was still complicated to get dozens of companies onto the platform.
Do you remember your first customer, your first win?
Yeah, first win was a few that we sort of won around the same time. So Eureka Tower was one of the first with Grocon, and go down to the site and there's a massive set of compactus units, and the project director was pretty old school construction guy. He said, I don't want to see another one of those fucking compactus units at the bottom of my building. I can't manage that. If you guys can help me do that, done. But we made the mistake of trying to.
I don't even know what that is, but a compactus unit?
Yeah, it's basically with those sliding bookshelves, and they'd have all the files in them, and they'd move. So basically, they had a physical copy of every single document on the project in the basement of the building they were building.
Wow. Okay.
So it was, so a lot of information. They hated it. It was hard. And so we did that for them. But the thing we made a mistake initially was we tried to charge all the different users, like the subcontractors, et cetera. But we eventually just went to one price for the entire project. So it was Grocon. We had Lowell McEwen Hospital with Hanson Yuncken in Adelaide was one of our first ones. And then Knox City Shopping Centre, so with ProBuild. Okay. So we had 3 customers kind of sign up at around the same time. We had to raise money, so different to you, we couldn't really bootstrap it. So we raised so it was 1.6, 1.7 million on a business plan.
And there was no
VC
back then.
No VCs.
No VC at all, was
There's no VCs, none. There was.
So who'd you raise from?
So being at McKinsey was great. So I went to some of the directors, and they were earning good money, so they were able to put a little bit into the business. So quite a few McKinsey directors and then family offices. So we went. Yeah, right. And the good thing about the family offices here in Melbourne was a lot of them were into construction, like development. So they understood the development construction process. So we had a number of them, a bit of family, and then, I think we had about 30, maybe more, 30 or 40 investors in the first round, just scraping together 50K here. I think the biggest investment was
angel investing before it was cool.
Yeah, angel investor. And it was literally me and Rob, Rob and I just going door to door, literally pounding the pavement, going and meeting with investors and telling them what we're doing. It helped that the dot-com boom was taking off, so there were people talking about technology.
I was going to ask you about that. What happened when the dot-com
crash
bust?
Yeah, well, we literally only just got out the door, raised the money, which I don't even think we'd raised. I think the crash happened in April. We raised in sort of May, June. Yeah. So we were able to we had enough conversations going that we were able to raise. But then NASDAQ kept sliding. So it was sort of it wasn't a crash and then it came up, it sort of crashed and then just kept sliding. So very tough to raise our second round of capital. And we got to about 20 people, had to lay off half the team, go back to basically Rob and myself and a few developers was what we ended up with. Rob and I was running everything. Rob did finance. I was doing kind of sales, marketing, whatever we had at that point. And basically we were supporting customers. We had probably one or two support people at the time and a few engineers. And that's how we came back to that. Hit the GF, let me get my timing right. So that was, dot-com crash. Then we hit the GFC, I think was. It was the Asia financial crisis. Was the next time we tried to.
You knew there was another disaster.
Yeah, and then another disaster which we raised on that, and then we literally raised GFC was our sort of big round out of the US in 2008.
Oh, really? Yeah. Did you raise during the GFC? Or
we before we literally got the money in.
You kept nailing it with these.
We were lucky, yeah.
You didn't cause these crashes, did you?
It's possible. Actually, a funny one with Rob was married in 2008, if I get my timing right. I think that's right, 2007 to 2008. We went across to Switzerland for Rob's wedding. So aside from being a business partner with Rob, I also got him a wife because he ended up marrying my host sister from my year on a student exchange in Switzerland. So she came over to visit, met Rob. I told him to keep his filthy fucking hands off her, but he didn't listen. Anyway, that one thing led to another. So we were over in Switzerland for the wedding. I was on my way back. We'd done the deal with Francisco Partners.
Yep.
I hit Hong Kong, come out, and the first thing I see, we're fine with the family. First thing I see is get out of the plane is that Lehman Brothers has gone down. Oh, yeah. But we didn't have the money at that point, so that's not good. Day or later that day or the next day, AIG goes down. So, okay, I'm not sure what we're doing here. We call the investor, Francisco Partners, and they were great. They honoured it. They invested, but we had a pretty nervous couple of weeks waiting for the money to arrive. And Rob had his least productive day ever, and he's had some pretty unproductive days. just hitting return on the computer to wait for that.
Waiting for
$60 million to arrive.
Did it land?
Yeah, it's even landed.
I remember that moment when we were first raised as well, like seeing those few million come into the account. It was just, that is a mind-blowing moment.
Yeah, $60 million. And then the other thing that was funny, the market was moving so quickly that we went to lay off money into USD because we had already started to build into US, like into Asia and the Middle East. So whole nother story there about how we built the business internationally. But we went to lay it off, and for some reason our head of finance took a long lunch that day or was out, and we missed the cutoff. Over the weekend, the Aussie dollar dropped like 20%. So we just basically lost our opportunity to move a big chunk into USD. So all these little things that happen, and we'd raised the money, so super happy about that. And then we managed to screw up kind of the transfers to get it into USD.
Which was really just like a couple of hours of bad timing.
There's the thing I was going to say, that round was quite interesting because we raised out of the US again because we couldn't raise a $60 million round. There's nobody that could write a $60 million check in Australia. And we're about 35 million ARR, so we're a decent size at that point.
And that was 2008?
2008, yeah.
Yeah, right.
So we'd sort of scaled the business quite well, particularly into Asia and the Middle East. So we're in Dubai, Abu Dhabi, Hong Kong, Singapore.
Yeah.
So we basically sent our team of Australian backpackers out to sell into anywhere there's a big project. And then once we got a project, we then start to build a team on the ground and had about 25 or 30 offices already at that point. One thing I learned out of raising capital is just take it when it's there. So raising 2 weeks before the financial crisis, the GFC, if we had have stuffed around and waited an extra few weeks, not signed the deal when we could have with Francisco Partners, I mean, we wouldn't have raised capital because the world changed overnight. So sometimes, I think sometimes founders can be a bit too trying to optimize the price of everything
for their value.
When you're ready to go and you've got a great investor and the valuation's reasonable, just get on with it.
The other thing I've learned is take a bit more than you think you need.
Yeah, I agree. Always take.
You never regret taking more. You always regret not taking more.
You don't need to go back and be so much
always need a few more million than you think you're going to need. And even if you don't, it's really helpful psychologically. Yeah. Okay, so let's fast forward. Not that the next 5 years weren't important, but let's fast forward to IPO.
Yeah.
You were crazy enough to become a public company CEO, which for everyone I know who's ever done it has said don't.
Quite crazy, yeah.
So when did you do that, and why did you do that?
So a couple of reasons. So we started, post that round 2008, we didn't raise again until our IPO in 2014. So we were, again, very different to perhaps today. We didn't keep raising capital. We partly because of the GFC, we kind of had to get right size the business. Just we didn't know what was going to happen, so we got ourselves to cash neutral. And basically just grew from our own cash flow, and we had a good, a solid amount of cash after that raise. The reason for the IPO was primarily around an exit, actually for early investors, but also for Francisco Partners, and they'd been in since 2008. We weren't big enough really to list on the in the US, so we decided to list in Australia, and at that point, we were one of the first tech companies, but at least there was a bit of an opening, I would say, for tech companies to list at that point. And there was more understanding that you didn't have to, we weren't profitable. We'd just been reinvesting in growth. So people were prepared to let an unprofitable company list on the ASX, or investors were. So a range of things sort of came together. I was in the US. I had 4 years in the US building the business over there. But we decided to do it in Australia. And we will come back to this, but worst day of my life was to do with the IPO, where we basically...
We'll come back to worst day.
Worst day ever as part of the IPO, but rolling forward to the completion of the IPO, listed. So we listed about $400 million, $400 million market cap at the time, and then had 3 years as a listed business. It was a bit of a roller coaster. Again, there's a whole another story there, but the day-to-day, you asked me about being a public company CEO. The one thing I didn't really anticipate was that the market moves independent of what you do for no particular reason, but you start to feel it. So I'd say to the team, don't look at the share price. It's irrelevant. It'll just do what it does. Then I find myself sitting in a meeting checking the share price a few times an hour and has zero bear. Like it's got nothing to do with what you're doing at work that day. Sure, over time it will... You build a great business, the share market will price it well, and you've got your earnings and everything to deliver and to report on. But day to day, what we did made, the share price would just move for just the whim of the,
Did
the
that
incremental
change behaviours inside your team?
Interestingly, it didn't. Well, yes, maybe not as much as I thought it would. So I think, there were certain people who, they would look at the share price, and if it was going down, they'd be, well, what are we doing wrong? And it's like, don't worry, we just got to run the business and do what we're doing, and the market will look after itself. But so we listed $1.90, I think. We went down. So we listed, wasn't a great, it was okay listing, but the price drifted. Then we started beating our forecast that we put into the market. And then every time a new analyst came on, they cranked up the price. So we went from $1.90 over the next year. I think we peaked at about $8.70 or $9.
Okay.
So share price took off. But then we had the reverse problem that the share price got ahead of itself.
Yeah.
Short sellers moved in. So we're the most shorted stock on the ASX for quite a while. And then we missed one of our, didn't quite deliver to the market what it expected on our earnings. We'd hit our budget, but the market expected more.
Yeah, okay.
Got absolutely pummeled. So just this sort of roller coaster.
Yeah.
And on the back of that, there's an opportunity for Oracle to come in. And we'd had a couple of, like what you said with a cloud guru, we'd had people sniffing around, talking to us, potential acquirers who might bring us into their business, and then being smacked from a price point of view gave the opportunity for Oracle to come in and to engage on a price with us. And so I think we'd been knocked down to maybe $3 from $9. So a fairly dramatic fall. Yeah. And a few interesting little anecdotes around that. But it was tough. That was really tough. And then we came back up to $5 and had started to engage with Oracle around that time. Yeah. I didn't want to sell. I really did not want to sell. I loved what I did, despite being a public company CEO. Yeah. Had no desire to sell, but we had a responsibility to shareholders. And so the board engaged. We set a price that we said, okay, well, if we can get to this price, we'll consider transacting, and ended up at $7.80 with.
Was that the price?
That was the price. So it's basically a 60% premium to what we've been trading at. Okay. And so it was very hard to say no. It's
hard to say no to that.
And I always felt,
and that's the thing as a founder, right? It's not just about you. It's about everyone on the team. Yeah, everyone who's backed you.
Everyone who's backed us. And we sort of felt if we didn't say yes to that, it would be the wrong decision for investors, but also the wrong thing for our team, for staff, for everybody that worked towards building the business. And so for me personally, it was kind of, it was a bittersweet. As I said, didn't want to stop running the business, but it was the right thing to do. And so we transacted.
Everyone makes a big deal about founders being, like it's they're in control and it's their business. But actually, I think when you're a founder in a position like this, I felt certainly the weight of responsibility of everyone who was on that journey. Because when you're in it, you see like the business is not just you. The business is everyone who's contributed their bloody asses off for a long period of time. And with not the same upside that you're going to get. And so I'm always amazed by how much people care just relatively to their upside. You want to make sure they get that. Yeah,
and we could have blocked the deal. I mean, Rob and I we didn't have enough necessarily to block the deal on a per vote basis, like on the actual number of votes, or number of shares to block it. But if we had to decide not to do it and just said no, I think it would have been very hard for the transaction to happen. But again, as you're saying, we took a view that we had to do the right thing for our shareholders.
Yeah.
But very strange then not wanting to sell. We've got an inbound bid from Oracle, so have agreed to transact with them to do the deal. We then go to DD process, which we had to keep quiet because as a listed company, we just couldn't let that leak out. So it was kind of strange people coming out the back door of the building to try and do all the DD with the Oracle people. And the Oracle guys, there was like 100 of them on the deal team. So they just swamped us with all these people.
Yeah.
We were transaction number 127 for them, so they knew what they were doing. The machine rolled in. And I must say, they did a very good job on it, but it was a machine.
It's crazy, isn't it? I had the same experience with Vista, who just buy companies regularly, and it's amazing how well they're set up for it.
I thought we could maybe do the deal with telling 10 people. We end up with about 30 or 40 people on the deal team doing various bits and pieces, everybody from obviously the board was involved and the financial, the finance team, but we also had a lot of our engineering team involved for doing engineering due diligence on the system, the code, etc. So a lot of people involved. But then, and anyway, then it all went through, and so it was 8 times revenue off ARR, so 8 times recurring revenue, and at the time felt like a very good price.
Yeah.
A year or two later, you talked about when you exited, like in the middle of COVID, it felt like a terrible price because everything is trading at 15, 20 times.
Yeah.
After the Sassacre, it feels like a pretty good price again.
You're back.
8 times ARR. So
we're back, baby.
So
we had a good
it all
deal.
depends what you peg it to. So 8 times revenue, and we never made a profit. So some people would say, "Oh, you sold for 1.6 billion, a couple $100 million in revenue, and you never made a profit. How were you possibly worth that?" Other people would say, "Why weren't you? Should have been worth 3 or 4 billion." And but
also a lot of the 2021 deals, were done like part cash, part stock, and so the multiples look really good. But then later the stock crashes, it isn't worth as much, and you end up back at a multiple that's more kind of in more reasonable range, right? Yeah. So
the thing, one last thing I just say that the best thing about the sale to Oracle was. Shareholders did well, but to go through and say there was 100 people at Aconex that made more than $1 million out of it. And they were, a big chunk of that was early staff. So people joined the business very, very early, and some investors too, but to have, some of our one of our first engineers, $1 million for him, there's just, a lot of those early staff, early people in the team, early employees did incredibly well out of it. And that's the thing when you can, when it becomes the whole team that's done well, that was great. Yeah,
it's the most exciting, amazing thing about selling a business is I still remember I was up, I think I had like 15 conversations in a row from 2 a.m. to 8 a.m. Australian time talking to American employees. It was literally one after the other telling them, we've sold the business, this is how much money you've made. It was like the most exciting 6 or 7 hours of my life. It was so cool.
We had when we were just trying to finalise the deal, our chairman, Adam Lewis, was away. And so we'd already done all the signatures and given that to the lawyers. And we had 2 sets of lawyers. So the other thing, because it was Oracle was acquiring, we had both US lawyers and Australian lawyers on both sides of the deal, essentially. Anyway, we had to get so we'd given all our signatures in. They were meant to release them. And for some reason, Oracle didn't accept his scanned signature. But he happened to be away. And he was down in Tasmania basically at a campsite. And we had to somehow get to him. He had to go to the and he didn't have his computer with him. So he had to go, his laptop with him. So he had to go to the local pub and literally say to the guy, "Have you got a fax machine at all?" And so we sent him the page, and he literally signed, and he said to the publican said, "Oh, what's that for?" He said, "Oh, it's a $1.6 billion deal." And the publican apparently almost fell over, just the scale of the deal, and it's being signed on a bit of paper to go through the fax machine. But for me, it was just this last minute of stress where it's all done, we're ready, we're signing everything, and then bloody Adam, I can't get him.
Okay, so you exited Aconex. Yep. I think you spent a bit of time there, but then stepped away. Tell me what that was like and what you decided to do next.
Perhaps not dissimilar to you. Spent a bit of time with the family. Went to France, went to Paris for a year. We'd already had a Paris office, Aconex did, so was able to go and work out of that office. Oracle had an office there, and Oracle was great. My role disappeared, so they wanted me around to help with the integration, and was working, but it was nice to do that for a year out of Paris. Came back, I reckon. Then sort of swung into COVID, so that made things a little tricky. But then we set up a family office, started investing. We wanted to invest back into venture in Australia, into startups. So started that. We set up a foundation as well, so we give money from that. So set that up as part of the sale, actually. So maybe for another episode, but a big thing for founders to think about is just how they structure themselves, particularly if you want to set up foundations and give money, the right time to do that. So did all that, sort of a lot of thinking about what next. Joined a few boards, too many boards, frankly. So I was on a few startup boards, on the board of Seek, which I'm still on. It's been great being on that, but probably did a few too many boards. And then we really started to formalise our investing. So set up Second Quarter as a secondary fund. Nobody was doing that in Australia. Yeah. So with the team there, so with Ian Beattie, Dave Traskio, with Andrew Sype, because we set up that fund. We're now into Fund 3 there, so that's been going really well.
Yeah, it's great fund.
Yeah, and just again, we on the Aconex journey, there's nobody doing secondary liquidity, and we had Andrew and a couple of other investors that would buy staff shares if they wanted to sell. So that was just good to have that from them.
Used to be a dirty word. Secondary.
It used to be a dirty word, yeah. And a lot of investors didn't like it. But actually on the Aconex, when we did the deal with Francisco Partners, Rob and I took a small secondary, relative to our shareholding. We took a little bit out at that point, but it was pretty unusual. So, but then it became more accepted, and we just thought it was a good thing for the ecosystem to have that secondary.
Yeah,
a secondary liquidity provider there. So did that, and then we've more recently flipped the family office investment that we're doing directly into startups. With that strategy is spun out into Glitch Capital, a founders fund, and we'll talk more about that in coming episodes as we bring in some of our partners in that fund and speak to them about their businesses. So that's been great to set up Glitch. Then the thing that probably really gets me excited is getting back into building another business. And so in those cases, building a fund is great, and it's building a business, but it's not quite the same as building.
It's not operating.
It's operating day
to day in the same way.
Yeah, it's not the same as building a new startup. And so we set up Firmable a few years ago, just as ChatGPT was launching. So it's a perfect time to be doing that. The minute we saw, and a couple of our, Karthik and Chas, so key guys, our leaders in our engineering team, ran data science at Aconex, and we really called it data science. That's what it was. It was doing and building our own models, and we were trying to uncover insight from the information we had sitting within Aconex. What AI did and what LLMs did was just accelerate all that work that we would have done very much manually at the back end. So brilliant time to be starting a business, and we're going to talk a lot about AI over the episodes. But this big new discontinuity coming through the market was it's a great time to go back in. What AI is doing in our space, and of course you've done the same thing with Cutable. So tell us why you're back in the game. And
I didn't want to miss AI. We now get to build the technology from sci-fi movies, and that's the whole reason I got into this. I love science fiction. I love inventing the future. So I wanted to get into the AI wave. I wanted to get back into building a business, and my only criteria was I wanted to build a business that couldn't have been built 2 years ago. It's it just was not possible without AI, so that it would be truly AI native and solving something new. And I met a couple of my co-founders, one of whom, Jack, was from advertising industry, 20 years in advertising, runs one of Australia's most respected advertising creative agencies. And we saw the problem there being that all advertising has gone digital. So all advertising is done on Instagram, Meta, and those algorithms require just fresh ads being created all the time. And the way that you win in online advertising is come up with 30, 40, 50 different ads of different concepts, like different actual creative executions, and run them. And then the algorithm will find the one or two that really work, and all the spend will go behind those, and none of the spend will go on the other 48. So they call that creative diversity. The problem is you have to make so many ads, and it's really expensive. Advertising has continued to operate the way it's always operated, with video editors manually changing every video, change the text, change the image, rework it. It's just hugely expensive. Companies are paying $5,000 to $10,000 per ad variation. So you just can't cost effectively feed the algorithm. So I saw that and I was like, well, this is the perfect intersection, because we now have AI that for the first time can do the creative tasks that humans could only do in the past. So massive problem and massive new enabling technology. So I just got really excited about, hey, let's go in and let's help brands. Let's really understand a brand's kind of soul and essence and aesthetic and their audience. And let's engineer a system that can come up with interesting new concepts, but still feel like them. And push them out en masse and let them test and test and test. So that's how I got into it. And I brought all of the best engineers in Australia from Cloud Guru, and we got the best creatives from Jack's advertising agency. And we literally shoved them in a room together and spent 2 years building it.
You got the band back together, or at least some of the band. Yeah,
some of the band. And it's been so much fun. So much fun.
Yeah, it was not similar with Firmable. The executive team is largely, one person is not Aconex.
Everyone I meet from Firmable is like, well, I do this at Firmable. I used to do this at Aconex.
So a lot of great people were able to pull back together, and then
why not? You work well together. And this is the good thing about the Aussie startup ecosystem, is the companies that succeed have built great talent in this country that can now go and start new businesses or work for other businesses.
Yeah, and one of the best things about Aconex was the culture we built there, and we hope, and I think we are replicating a very similar culture at Firmable, and largely because of a lot of the same people. Even last night out with the trivia night with the SDR and sales team, and they're all probably half my age, to be honest, but I had a great night doing trivia with them. But it was just we're building a great culture again, and that's fun as well. It's not, so it's a technology, but it's also, at the end of the day, being with people, being with great people, and just loving sort of this building a new team. And we'll talk more about Firmable down the track, but it's just the ability to use in this case, for us, AI to assemble data in a way you couldn't do before. You just couldn't.
Yeah.
I mean, we even started the business with manual curators to manually curate some of the data. We don't need them now. They've gone into other roles, but just the whole business model's changed in terms of how we think about building the data set. So anyway, more on that later.
Love it. Okay.
Right.
So
one of the things we want to do in this podcast is really tell the stories around where things are bad sometimes, and that happens. No journey is easy, where we've made mistakes, where we've stuffed up. So we could do worst day in the office.
Let's do it.
Your worst day? Worst series of days, perhaps?
There's a few. Probably the one that comes most immediately to mind was when we raised our Series B. So like before we did A, didn't know anything about VC, got a little bit of interest, got a round raised, but kind of felt happy to get that done. And then after the A, it just got inundated. You know what it's like with VCs are just constantly contacting you, wanting to get on your radar, wanting to talk to you. And it felt like, before we did the A, no one wanted to know us. Now we've done the A and we've got the money. Now suddenly everyone wants to know us, but we've already got the money. Like this is a really weird, it's a really weird setup. So I think going into the B round, like a year and a half later, I had a bit of hubris. I think I thought it was just going to be easy because we just had all this inbound. Everything seemed to be going well for us. Like things were working. So we went out for the B round. We organized these 2 days in San Francisco where we just went, and we were kind of exclusive, but we picked like all the best VCs. Let's go.
So you went like office to office, or you went somewhere and they came to you? Or
no, we went all around Palo Alto and office to office and downtown San Fran.
Yeah, down Sand Hill Road.
Yeah, did it all. But we'd kind of kept it to all the best VCs because we thought we were in a great position. And we had really good networks there. So I spent 2 days pitching and I felt really good about it. I was like, we are like nailing this. Like this is going to be so good. And was just feeling great and got on the plane to fly back to Texas where our office was. And in that like 3-hour journey from San Fran to Texas, we had internet on the plane.
Oh, the no's started coming through.
All the no's just started coming in. And I think by the time we landed, every single VC except one that we'd pitched to had said no.
Oh, wow.
Within a day. And I just remember like, it was just so devastating.
Yeah.
I think because we'd put so much work into those pitches leading up to it. We had so much hope. It felt like it was going to work. And we had been building relationships with those VCs for like some of them for like a year. And we even had personal connections with some of them. So to just get the no. And the last one that hadn't said no that we'd pitched to that time was Goldman Sachs. And so I was holding out hope for them. And the next day I took my kids to Disney World in Orlando.
Yeah.
And it was literally while I was at Disney World, like the kids are on a ride, I get a phone call from Goldman Sachs and they're like, we're out. I was just like, and then I had to pretend to be happy for the rest of the day with the kids. That was a really tough few days. But
quick thoughts. We raised capital also from Francisco, as I mentioned before, but as part of that round, Sequoia got in touch and again, something not to do is go and pitch to your dream investor straight off the bat before you pitch to anybody else. So it was like, Sequoia's interested, went in and they weren't interested. They heard our pitch and it was our first pitch. We hadn't even honed the pitch. So it was just so dumb. We should have done the C grade VCs, the sort of layer it up and then do Sequoia down the track. I mean, Francisco Partners was great, but it would have been nice to have Sequoia down the track as well. But just that whole process.
I think also I learnt the game where like there was one VC, very big name VC, who had been following us and we used to run in-person events like conferences and they would come to all our conferences and they'd want to meet us and we love what you're doing here, that you're the thought leaders in the space. And then when we went and pitched them, they came back and they're like, we just don't know how big this business can really be. And I'm like, well, why have you been turning up at all our events? You know what I mean? And it's like, you have to learn that not to take it personally. And also funds are like, there's a lot of competing dynamics in a fund. Yeah. There's different partners. Like you might have one partner who's all about you, that's been all over you. But then when it goes to IC, there's someone who just really doesn't like it and they've got a veto or they sway everyone else. So you can't take it too personally. I think it took me a while to learn not to take it personally. I don't know if I've still entirely learned my lesson. It's still hard to
take it very personally when people say that. Even selling Aconex, I used to take it very personally when a construction company said, no, we're not going to use it on a project. Like, what do you mean not going to use it?
Yeah, why would you not use this?
Product.
It's amazing.
Why wouldn't you want to use it?
This is incredible. Yeah, it is. It's hard. I think you just have to try to disconnect. But I don't think anyone does it maybe objective as they purport to be. Yeah. It's always hard. Yeah. So what about you? What was hardest day?
A lot of bad days. The worst, it wasn't so much a day in the office. It was similar to you, as on a plane. Well, it ended up on a plane, but we talked about the IPO before, and we'd been working towards that for probably 6 months. We had to move all our accounts we'd moved them into US GAAP.
Yeah.
Partly because we're in the US, and then we had to get them all done back into Australian accounting standards. A huge amount of work, just getting everything ready. We had the banks working with us, the lawyers, so getting everything ready. Did our roadshow, so sort of the pre-deal roadshow. We did a pre-deal roadshow, then we did the deal roadshow. We did it in Melbourne, Sydney, Hong Kong. I think we did Auckland as well, and possibly Singapore. But anyway, we've flown out of Hong Kong. Everything seemed good. We had our President's Club in Italy, actually, and so that's where our best. One of the best things actually for any team to do is, if you've got a sales team, just have President's Club. So we had that for our best performers, and they can bring their partners. Anyway, so went to Italy. That was great. So had a few days there, and then I was back in Rome with my wife. So my wife came to that. We tried to get a unit near the Trevi Fountain, and it was supposed to be nice, but actually Trevi Fountain was under renovation, and you had to stand on a chair sideways to be able to see the Trevi Fountain out the window. So it wasn't a very nice hotel room. It was tiny. I had to take a call from the banks first thing in the morning about how the book build had gone on the Monday back in Australia. So it was Monday morning Europe time, and they'd sort of end of day here, and it was 5 a.m. or something. So my wife, I didn't want to wake her up. So this, he went into the bathroom, sitting on the toilet, and within 10 seconds of the banks getting on the phone, it was clear something had gone wrong. So we went away thinking, all done, we're raised.
Yeah.
Right. So we didn't cover the book. And once I didn't cover the book, we were doing $220 million IPO, and we had $250 million of commitments or something. I'm like, well, that's good. Like, no, we need they need $500 million of commitments to be able to not allocate to everybody properly. And I don't know, it was just bankers being bankers. And I'm like, well, I thought we've covered it. It's like, well, no, we need more than that. Maybe it wasn't 500, but it was more than the 220, but it wasn't enough to, by the time I assume some of them wanted to scale back, and some of them they didn't want to give, I don't know.
They all overestimate what they want to make sure they get the thing they want.
And so it would have been, and then their view was it would trade poorly because we didn't have enough demand. So the banks basically said you shouldn't do it. And so this thing we've been working to, literally all in the space of about 30 seconds on the phone, blew up. And so we were then flying back to Australia that day. So it was the worst 24 hours.
Couldn't even see the Trevi Fountain.
Couldn't see the Trevi Fountain. And thankfully my wife was with me. So I think I would have struggled to come back on my own. Might have jumped out a door.
So you cancelled the IPO at that point?
We had to pull the IPO. So we didn't quite know what it meant. So I then came back, and we hadn't done an IPO before. So we said, we'll pull it, and then we will see what happens. What does that mean? So we come back, and it had a pretty bad couple of weeks because this thing that we've been working towards had just stopped. And so I remember taking the training to into the office, particularly because we'd moved back to Australia for the IPO. So we'd moved back from the US. Right. Whole family had moved back for this IPO that had now fallen apart. I remember taking the train in from Elwood, and I'm like, what a shit bloody time. Anyway, so every morning sort of trudging into work, so to speak, and trying to keep a brave face for it all. And then as it turned out, one or two, we resized it. So we worked well with the banks. So we had Macquarie and UBS, and we were able to basically resize the IPO. Probably the single best thing that happened out of that was the banks have said if you can escrow not just your shares but shareholders, early shareholders, then we think we can get it done. So and they said if you can get enough shareholders to agree, and Rob and I said, well, we'll just jump on the phone and ask them. They're like, would your shareholders do that? I'm like, we can just ask them. So Rob and I took a list of the shareholders, and we just looped through them and called them all and said, to get the IPO away, we're going to need you to escrow your shares. Rob and I will escrow. I think we had a very long escrow, like 15 months, and we asked other shareholders to do 6 months or something, just to get it trading, get the company trading properly. So sort of resurrected it, but lower valuation. We raised 140 million rather than 220. So we were able to kind of recut it. But just when you've been working towards something and it just
you've moved your family
falls apart.
across the world.
Yeah, it was wasn't just the business side, it was this personal side.
Everything.
And my wife was living in the US, and we came back for the IPO. And the kids, pull them all out of school, move back, and then it's all full.
So our two moments of disappointment were at the Trevi Fountain and Disney World.
Well, it's funny when you mentioned being at a theme park. So I was listening at Disneyland in California, and the time we got I mentioned our share price got hammered at one point. That the miss that we had was the first I heard of that was in Disneyland, where our CFO called us up and we're about to report like a week later, 2 weeks later, we're getting all the numbers ready. He said, "Oh, the numbers aren't good. We're off our forecast." I'm like, "Hang on, 2 weeks ago we were looking fine. What's changed?" And yeah, something had gone wrong in how they pulled together. Anyway, we were missing our numbers, what the market thought. So just getting that call, I knew we were kind of going to get smashed. And so you're in Disneyland, the kids are there, and you're trying to enjoy it, and you're just thinking, we are going to get absolutely torched. Then we had to work out, do we actually have to inform the market ahead of time? And we worked out we probably have to. So not only are we missing the numbers for our earnings, again, they weren't our budget so much as what the market expected, but because it was out of line, we had to so within a few days, we're basically telling the market we're going to miss. And share price dropped, like 45% on the day. Pretty rough. But, sitting at
there's a lesson
of the Caribbean, and
that's a lesson for any founders listening. Don't go to Disney World.
When you've got something big happening, don't take the kids to a theme park. All right.
Cool.
So one of the things we want to do as we go through our founder podcast interviews is get recommendations from people on the best book they've read, or maybe a podcast they're listening to. I'm going with one which is kind of a bit old school on two fronts. So we're building a sales team here, and one of the best things one of our investors said to me was, when I had to learn how to sell myself, is go and get a sales book, go and learn how to sell. And so I bought some of those cheesy 1980s sales books from
really?
Yeah, just from Zig Ziglar and people like that. The one I know, but they kind of teach you how to sell. And so I bought, as we're building the team here, bought the library, got all the 80s cheesy sales books, and I've sort of lined them up. So things like the Challenger Sale, Zig Ziglar, The Art of Closing the Deal, Tom Hopkins, some great sort of, how you manage objections. Spin Selling is another one that Neil Rackman that we got. So got about 8 to 10 sales books that were good for me and good for our team at Aconex. So we've got that for the team. And then one very thin
yourself? Were you reading it yourself?
I read them all myself. I've read all these books. I haven't read them recently, but read all of them. So I literally learned how to sell through these books. Hardest 6 months, aside from some of the bad days I've had, the toughest 6 months I ever had at Aconex was the first 6 months when I was selling. Hadn't really done it. I had to learn how to do it. And then one little book I gave to everybody was the 1 Minute Manager. Again, pretty old book, but just how to be. It's a very simple guide for new managers, just to be a good manager. So we can talk about it another time, but it's 1 Minute Manager. Great little
1 Minute Manager. I like it. So it's a 1 minute. You can learn it in 1 minute.
I don't think,
you're going to manage for 1 minute.
It's little things like just very simple managerial thing. Like if you're going to compliment somebody, somebody does something well, compliment them, let them know they've done something well. Do it in public so they get if you're going to reprimand in private. If you have to give somebody negative feedback, ideally do it once, and then you've done it and you move on. You don't keep coming back to it. So it's not rocket science, but just and the 1 minute it's
actually amazing.
It's like a 70-80 page book. It's really easy to read.
But it's amazing how many people don't
do simple things and just catch people doing the right thing. A lot of managers try and catch. They'll call somebody out if they've done the wrong thing. Well, catch them doing the right thing. If somebody builds something, so we've got one of our engineers now who's completely changed. Actually, was one of our UXers has become an engineer and completely changed how he does things through the use of AI. And so, just compliment the hell out of him on it. Just make sure that people are rewarded for what they do.
So good. Book I was going to recommend, kind of similar, an old school basics book, The 5 Dysfunctions of a Team, Patrick Lencioni. I think it's such a good book. It's just, the thing I like about it is you can read books and they'll give you all the advice, but they're quite dry and boring. Whereas this is a story, like he does it as a narrative. So it's a CEO who goes into a business and is a new CEO coming in, replacing the founder CEO. And so there's all the dynamics people are used to with the founder, and then the new CEO is watching all the executive dynamics and all the politics between them and kind of picking apart all of the dysfunctions within the team. And the key point of it is, like, as a CEO, your leadership team is your core team.
Yes.
That is your team, and that team has to function well. And everyone on that team should not be considering their department their first and foremost team. The executive team is their first and foremost team.
Yes,
and you have to function kind of like a sports team do. You all have your roles and you support each other, not undermine. And I think it's so valuable for really any stage of business.
Yeah. Should put a pin in that one and come back to how we build teams, because we're doing it obviously a second time, both of us, and I'll learn a heap building the team at Aconex, the executive team, and so many things we got wrong, and we got some things right, obviously, but just try not to make the same mistakes.
Yeah, totally. Cool.
So been great chatting, Sam. Yeah. A lot more to drill into. It's just building a company, building a startup. There's so many things that go wrong, and you've had the ups and downs that we've all had, and it's great to hear all of that. We're going to do a lot more of these. We've got a great founder coming in next week, Mark Finn from Roller. So we've talked a lot about theme parks today, and don't be in a theme park when you're raising capital. Roller sells their software to theme parks. That's a SaaS business for theme parks and other entertainment businesses. And he'll tell us more about that. But it'd be a great episode with him and how they've built a company again from Australia, from Melbourne in that case, into the US and everything there.
Incredible business.
So and we'll keep calling out as Imperfect Company, as we are, we want to keep calling out things that we've got wrong and things that you can all learn from in listening to the podcast. So leave us a review. Let us know any founders that you think we should bring into the podcast. And if you can share it with a founder, like the most important thing for me, and you probably agree, Sam, is that if we can help one founder a day or 10 founders a week do better with their business and help build a bigger company, that's great for Australia and great for the world.
I think also as a founder, saying that people have gone on and done the kind of things you're hoping to do have not had it all figured out. And they've had eat a lot of crap along the way, frankly. And being able to just identify with those stories, I think is really important.
Great. Well, thank you. And thanks for everyone listening. And we'll see you next time.
Cheers.